What is the best way to invest your money? I've been on the Reddit boards. It's a pretty common response to say, just put it in the S&P 500 and chill. Well, this can seem like a pretty smart idea considering the recent outperformance of the S&P 500 relative to comparable investments. It may not be the wisest approach. I'm going to be talking to you about why you need to consider a different approach for your investment strategy. First is looking at the small cap premium. It's been historically documented in the French and FAMA studies. Smaller companies over long periods of time outperform larger companies. If you think about it, a big company generating over $100 billion in revenue is going to have a much more challenging time growing their revenue by 20 or 30% in order to see gains in their share values. A smaller company doing only $1 billion in revenue could have a much easier time to achieve a similar percentage growth. The second big idea is that you need to be invested globally and internationally. If you look at the past 5 decades, going back to the 70s, and look at how different investment strategies have done in that time period, you can see the S&P 500 actually underperformed treasuries, which is basically a risk-free investment, in 2 of the last 5 decades. That's basically a 40% chance of underperforming what would be considered a risk-free investment. Now, past performance is no guarantee of the future, but this is data that's worth considering. If you compare that to a globally diversified investment strategy, there has been no decades in the past 5 in which the globally diversified equity strategy that includes smaller companies, larger companies, and a variety of international companies actually underperformed the treasury. It can seem easy to look at the most recent history without considering what things have done if we zoom out and look at investments in a longer time frame. Lastly, it's important to consider if you are close to retirement, your investment equation is going to change. You need to start thinking about income generation as opposed to asset accumulation. When you're in your early years, it can make sense to have a strategy that's heavily oriented towards equity. And maybe you're still oriented towards equity in your retirement, but you need to start thinking about other investment instruments that are going to help you weather the different cycles of the markets as things go up and down. As you get within 3 to 5 years of retirement, researchers would consider this a risk zone. Those first 3 years before retirement and 3 years after retirement is where your retirement is really at the greatest risk to market volatility. This is because if the market takes a dip right before you retire or right after you retire, and you're 100% equities, you are going to be selling at potentially significant losses, diminishing the probability of your future success in retirement, maybe significantly. You need to start thinking about different types of approaches to mitigate your income needs and the needs to sell investments to produce income. This can be done with different buffer zone strategies, including a mix of cash and fixed income in your portfolio. But depending on your unique situation and risk tolerance, there may be other approaches as well. Hope you found this video interesting. If you want to hear more about our adventures in financial planning, go to parkmountfinancial.com and subscribe to our channel.